And thank you for tuning in. Today is Wednesday, May the 14th, about 20 minutes of 5 a.m. Pacific time, and I want to spend a few minutes talking about a hedge that I had in CBOE, CBO stock. So let's take a closer look at it. Now, what I do want to mention here is that let's take a quick peek at beta of beta of the stock. And if we scroll over, we see that it has a very, very low beta, which I've talked about a video or two ago, of 0.26. So it has a beta of 0.26, which over a period of time you wouldn't expect this to move much relative to the overall market, using a SPY as a proxy. Relative to the SPY, you wouldn't expect too much movement. However, it has not turned out to be the case. Going back to April, early April, when all the excitement in the market really kicked in on Liberace or Liberation Day, market got hit hard and CBO got hit hard too. It went from a high of 234 on April the 3rd of April, all the way down to 200, low of 288 cents, rallied to 235, back down to 215 and change a couple of days ago, 215.65 this Monday. Last week, on the 7th, before it dropped down to 228 from a high of 236, by the way. This price was trading at around 234. Let me see when I put this trade on. So it was trading at around 234, I believe, and I did this at almost 7 in the morning. I bought a put at the 230 strike for $1.65, $165. Let's see, let me take a quick peek here. So on the 7th, let's get to this date. On the 7th at half hour might be a little bit better. On the 7th, early in the morning, it was trading 11:30. Let's go to 7 a.m. That's a half hour. So let's just say it was trading around 234-ish on May the 7th, and I bought the 230 strike, the 230 put for $1.65. Now I want to go over the analysis tab to show that at that time, this is going to show 95 shares, so it's going to be difficult to show what I had. But basically, buying the put at 230 created a synthetic straddle. So remember, it's long 50 shares, and that left me with 50 shares of risk to the downside, which I did not want. I bought the put, and that gave me the right to sell 100 shares at 230. Now, let's say that we're at prices much lower than 230. The put kicks in. It basically converts delta-wise to being short 100 shares. So being short 100 and being long 50 left me short 50 at prices significantly lower than 230. So the straddle, long 50 and short 50 from 230, this trade basically became a one-sided directional play with a lot of risk into a straddle. And again, this is on a stock with a very low beta of 0.26. And let's just take a look, see what IVR, where that currently resides, around 16.8. I can look at a chart to see what it was at the time, I guess. IVR. Let's see. I'll do it over here. Okay, so if we go back, let's turn this into a daily. On the 7th, prior to the 7th, I had an IVR, very low IVR of about 20. Yeah, so let's say about 20. Why does this not look right to me? Well, I'm just surprised at how low this IVR has gone. But anyway, it went from roughly 20 down to about 7 or 8, back to where it currently resides at 16. Okay, so you wouldn't have expected such a violent move in either direction on this, yet that has not been the case. So for very short periods of time, short time frames, metrics such as beta can be quite deceiving, and they can throw you off if you're following it a little too, I don't want to say blindly in the short term, but you don't, if you forget to realize that it's just an average. Beta is an average over a longer period of time, and a lot can happen in a matter of a few days. So anyway, rather than sitting on the risk, I was sitting on the risk of long 50 shares, converted it to a straddle by purchasing the put, and as prices dropped on Monday, this previous Monday, quite a bit by the way. Look at this quick chart here. You can see that it got as low as 215. Put kicked in, which left me increasingly short as the market dropped. So if you're getting shorter and shorter as the market is dropping, you have the opportunity to buy shares. And since this was one put representing 100 shares, and I was already long 50, I had 50-ish to buy. So I started buying 10 at a clip to begin with. Bought 10 at 224 and 30 cents. Bought 10 at 223, another 10 at 222, 10 at 220, and 5, all the way down to 216. That left me, purchasing those extra shares, left me delta neutral, and is at these current prices, or at least around yesterday's close at 220 and change. I had this being long, basically one share of SIBO. So not only was the risk to the downside neutralized by purchasing the put, but the put converted the trade into a vol trade. I did not care about direction, just as long as it moved. Either way, it was good for me. And as you can see, the profit worked out pretty well because I was getting shorter and shorter as the market went down thanks to the put. So this basically demonstrates an example of how to hedge risk and protect yourself. And in this example, it worked out quite well. And note that this put expires this Friday. So if SIBO increases in price between now and Friday, let's say it goes up to 230, where the strike of this put is, well, then I'll have shares that I can sell, because rather than being flat, I'll be long. So it could increase in profit even more. So you make money on the way down, you make money on the way up. Possible. I'm not saying it's going to go up. I don't know. I have no idea. It could go to 230, could go to 200. But as it stands, it provides me with the opportunity to benefit from an increase in price before expiration, should that happen. Again, flat. If the price of SIBO increases, I'll get increasingly long, and I'll have shares to short. I'll have shares to sell to get me back to flat. Interesting way to hedge risk. I don't know if a lot of people would have considered converting the position, long shares, 50 shares at that, to a straddle, where you're basically long 50, short 50 from the pin price to straddle point of 230. Something to think about. Okay, thank you for tuning in. I hope that was helpful. I will catch you guys next time.